Welcome to Bookish and Beyond, money, where financial wisdom comes to life. In each episode, we break down the world's most impactful finance books, from money management guides to investment biographies. We explore key takeaways, author insights, and draw modern parallels to help you navigate today's financial landscape. Craving even more? Subscribers enjoy exclusive access to detailed book summaries, study guides, and timeline PDFs. Everything you need to deepen your financial savvy. Hit subscribe and turn on notifications so you never miss an episode. This is Bookish and Beyond. Money?
Hey everybody, and welcome to the Deep Dive. Today we're going to be looking at just one resource, and that's the YouTube audiobook called The Simple Path to Wealth.
Right.
It's all about how to reach financial independence, but it does it in a way that you might not expect.
Interesting.
We're going to be ditching all those get-rich-quick schemes.
Yeah, get out here.
And we're going to embrace a simpler approach.
Love it.
Now, one of the things I think is really interesting about this book is that it actually challenges conventional financial wisdom.
Huh. How so?
It's not about using complicated investment strategies or trying to time the market.
Right.
Instead, it's about building wealth slowly and steadily.
Okay.
Using just simple common sense principles that anybody can use.
I like that.
Now, to kind of set the stage,
Okay.
the author starts the book off with a parable.
Oh, cool.
And it's a really insightful parable.
Okay.
It's the story of the monk and the minister.
The monk and the minister.
It's really short, but it's super insightful.
All right. I'm intrigued. Lay it on me.
Okay, so basically, this wealthy minister runs into his old friend, who's a humble monk.
All right.
And the minister sees his friend's simple life and thinks, man, you could do better for yourself.
Oh, so he's like, come on, you got to up your game.
Exactly.
Right.
Maybe cater to the king, live a life of luxury.
Right, right.
But the monk totally flips the script.
What does he say?
And says, maybe the king should learn to live on rice and beans.
Oh, wow. So he's like, simplicity is key?
Exactly. He's saying that true freedom comes from just simplifying your needs.
Mm-hmm.
And finding contentment in the present rather than always chasing after these material possessions.
Makes sense.
And that leads us perfectly into the three key principles of this simple path.
All right, let's hear them.
Number one, spend less than you earn.
Okay, that's a classic.
It sounds obvious.
Right.
But this book really digs deep into the psychology of consumerism and how we're constantly being bombarded with messages to buy more stuff.
It's true. It's everywhere.
And it offers some really practical strategies for breaking free from that cycle.
Like what?
It's all about being mindful of your spending, prioritizing your values, and finding that contentment in experiences rather than material things.
I'm with you.
Principle number 2 is invest the surplus.
Right. Make that money work.
Once you've got your spending under control, you can start putting that extra money to work for you.
Right.
This is where I think the book gets really interesting.
How so?
The author advocates for a very specific investment strategy, one that's focused on simplicity, diversification, and long-term growth.
Sounds promising.
And the cornerstone of that strategy is index funds.
Index funds.
The author is a huge proponent of VTSAX.
VTSAX.
It's the Vanguard Total Stock Market Index Fund.
Okay, I've heard of that one.
What's great about this fund is that it lets you own a tiny piece of almost every publicly traded company in the U.S.
Wow. So you're talking about
like 3,700 businesses.
Seriously.
In one single investment.
That's incredible diversification.
It's a fantastic way to diversify your portfolio and just ride the wave of the overall market growth.
It's like you're betting on the entire U.S. economy.
Now I know what some people might be thinking.
What's that?
Index funds. Isn't that just settling for average returns?
Yeah, I can see why people might think that.
And that's a common misconception.
Oh, really?
Average in this context actually means outperforming the majority of professional investors over the long term.
So you're saying most pros can't even beat the average?
Even seasoned experts struggle to consistently beat the market.
Huh. Kind of mind-blowing.
The author himself actually admits to wasting years trying to outsmart the market.
He did.
Before he finally realized that index funds were the smarter and simpler approach. It's like trying to be a professional athlete.
Oh, okay.
A select few can reach that level of success.
Yeah.
But for most of us, it's just not realistic.
Makes sense.
Now that brings us to the third principle of the simple path.
Okay, hit me.
Avoid debt.
Avoid debt.
The author is adamant about this.
Really?
He calls debt the single biggest reason
Wow.
most people fail to achieve financial freedom.
That's a bold statement.
He really emphasizes how debt creates this cycle of dependency where you're forced to work just to pay off those interest payments.
It's like you're stuck on a hamster wheel.
Exactly.
Okay.
It's like a weight that holds you back from pursuing your true passions and living life on your own terms.
I feel that.
Now, he does acknowledge
Okay.
that there are certain types of debt, like a business loan or a mortgage, that can be beneficial sometimes.
Right. Sometimes it's necessary.
But he stresses that those decisions should be approached with extreme caution.
Be smart about it.
It's about being strategic, not impulsive, and making sure that you fully understand the risks involved.
Absolutely. Got to do your homework.
So now that we understand, the foundation of the simple path,
Yeah, the basics.
let's explore how the author suggests actually putting these principles into action.
Okay, let's get practical.
He goes really deep into specific investment strategies.
Right.
But I think what's most valuable is his emphasis on the psychology of investing.
Oh, that's interesting.
He really gets into those emotional traps that can sabotage even the most well-intentioned investors.
Like what kind of traps?
Things like fear and greed
Oh, yeah, those are big ones.
that can lead to impulsive decisions.
We've all been there.
He talks about how fear can cause people to sell their investments during a market downturn,
Yeah, panic selling, classic mistake.
even though historically the market has always bounced back.
Right, it's about playing the long game.
And then greed, on the other hand,
Okay.
can lead people to chase after the latest hot investment,
Oh, yeah, trying to get rich quick.
often ignoring the fundamentals and ending up with losses.
Ouch, that hurts.
So instead of trying to time the market or
Yeah.
pick individual stocks,
Yeah,
the author encourages a more disciplined, long-term approach.
makes sense.
And a key part of that approach
Okay.
is understanding market volatility.
For market volatility.
The book acknowledges that the stock market will inevitably experience ups and downs.
That's for sure.
And trying to predict those fluctuations is virtually impossible,
Yeah. Even the experts get it wrong.
even for seasoned professionals.
Right.
But what you can control
Okay.
is your reaction to those fluctuations.
So it's about managing your emotions.
Exactly.
Yeah.
Instead of panicking and selling when the market dips,
Right.
view it as a buying opportunity.
Oh, that's interesting.
Historically, those dips have often presented excellent opportunities to purchase quality assets at a discount.
So you're saying buy low, sell high.
He provides some great historical data to support this.
Oh, like
The
that.
Dow Jones has steadily grown over the last century,
Wow.
despite wars, recessions, and countless other crises.
That's pretty reassuring.
And the S&P 500 has delivered impressive returns over the past 20 years, even weathering one of the worst market crashes in history.
So the market is pretty resilient.
Exactly.
Um,
So the takeaway here is that time, not timing,
Okay.
is your greatest ally when it comes to building wealth.
Patience is key.
The key is to stay the course, ride out those inevitable market storms,
Hang in there.
and just focus on that long-term horizon.
Got it.
So we've covered a lot of ground here,
Yeah.
from the simple yet powerful principles of the simple path
Right.
to the importance of index funds and embracing market volatility.
It's been a good overview.
But that's just the tip of the iceberg.
There's more.
There's so much more to unpack, and we'll dive into that in part 2.
Looking forward to it.
All right, welcome back to the deep dive.
Part 2. Let's do it.
In part 1, we really explored those foundational principles of the simple path to wealth.
Right. Spending less, investing more, avoiding debt.
Exactly.
The basics.
Now let's delve a little bit deeper into the author's investment strategy.
Okay.
Particularly his emphasis on index funds.
Right.
You know, one thing that surprised me
Yeah.
was how much the author emphasized the psychology of investing.
Oh, interesting.
He argues that even smart people can make bad investment decisions
Yeah.
if they let their emotions get in the way.
That makes sense.
So it's like intelligence alone isn't enough to beat the market.
Right. You need something else.
You need discipline and emotional resilience, too.
It's like a mental game.
Totally.
Okay.
He talks about how fear and greed
Oh, those are big ones.
can drive investors to make impulsive choices.
Fear and greed.
Fear can lead to selling at the worst possible time.
Right when you should be buying.
And greed can tempt people to chase after those risky investments
Oh, yeah.
that promise unrealistic returns.
Get rich quick schemes.
Exactly.
Right.
It's like that old saying,
What's that?
buy low, sell high.
Right.
But in reality, most people do the opposite.
Yeah, they get scared.
They get caught up in the frenzy of the market.
Oh, I see.
So that's why their author advocates for a more disciplined approach, one that focuses on the long term,
Right.
rather than trying to time the market or pick individual stocks.
It's about the big picture.
Exactly. And that's where index funds come in.
Index funds, yeah.
He's particularly fond of VTSAX.
VTSAX.
Yeah. I know we touched on this in part 1,
Right.
but I'm curious to hear more about why he thinks this is such a powerful tool for building wealth.
Okay, so VTSAX,
Yeah.
it's the Vanguard Total Stock Market Index Fund.
Right.
So first and foremost, it offers instant diversification.
Okay.
With a single investment, you're essentially buying a tiny slice of the entire U.S. stock market.
Wow, that's amazing.
Yeah. And that's a level of diversification that would be incredibly difficult and expensive to achieve if you were trying to pick individual stocks.
Right, that would be a nightmare.
Yeah, it's like you're buying a basket of all the apples in the orchard
Oh, I like that analogy.
instead of trying to pick the best ones individually.
That's a good one.
Thanks. And over time, the stock market as a whole tends to go up.
Historically, yeah.
There will be ups and downs along the way, of course,
There always are.
but history has shown that the long-term trend is upward.
Up and to the right.
Exactly.
Okay.
And that's why he stresses the importance of staying the course,
Yeah.
even when the market gets volatile.
Don't panic.
I remember him saying something like, the market doesn't care about your feelings.
That's good.
It just does its thing.
Right.
So he emphasizes that market fluctuations are inevitable,
Part of the game.
but they're not something to be feared. In fact, he sees them as opportunities to buy quality assets at a discount.
When everybody else is selling.
Exactly.
Okay, I like it.
Okay, so we've talked a lot about stock.
Stocks. Well, what about bonds?
Well, yeah, bonds.
I know the author also recommends including bonds in a well-balanced portfolio,
Right.
especially as you get closer to retirement.
Yeah, you want to reduce that risk a little bit.
Exactly.
Okay.
So he suggests Vanguard's Total Bond Market Index Fund,
VBTLF.
VBTLX.
Okay.
Now, while stocks are known for their growth potential,
Right.
bonds provide stability and income.
Yeah, they're a little bit safer.
They're generally less volatile than stocks,
Right.
which can help cushion your portfolio
Okay.
during those market downturns.
Yeah, a little bit of a safety net.
So it's about finding the right balance between risk and reward.
Balancing act.
Stocks offer the potential for higher returns,
Right.
but they also come with more risk.
More risk, more reward.
The bonds, on the other hand,
Yeah.
offer lower returns but provide more stability.
Got to find that sweet spot.
Exactly.
Okay.
And that's where the concept of asset allocation comes in.
Asset allocation.
It's about finding the right mix
Oh,
of
that's true.
stocks and bonds based on your individual risk tolerance,
Yeah. How much risk can you stomach?
your time horizon, and your financial goals.
It's different for everyone.
Exactly.
Okay.
He mentions 2 specific portfolio examples in the book:
Okay, what are they?
the wealth accumulation portfolio
Wealth accumulation.
and the wealth preservation portfolio.
Okay.
So the wealth accumulation portfolio is 100% invested in VTSAX.
All stocks.
It's a more aggressive approach
Right.
that's suitable for younger investors who have a longer time horizon to ride out those market fluctuations.
When you're young, you can afford to take more risk.
Exactly. And the wealth preservation portfolio
Hey.
is 75% VTSAX and 25% VBTLX.
Okay, so a little bit more conservative.
A little bit more conservative. It's designed to provide more stability
Okay.
for investors who are nearing retirement or who have a lower risk tolerance.
Right, got to protect that nest egg.
So it's not a one-size-fits-all approach.
No, it's personalized.
It's about customizing your portfolio to match your individual needs and goals.
I like that tailored approach.
And as your circumstances change, so too should your portfolio.
Right, it's not set in stone.
That's why he emphasizes the importance of regularly reviewing and rebalancing your investments
Got to stay on top of it.
to make sure that they remain aligned with your evolving needs.
Makes sense. Keep it up to date.
Now let's shift gears a little bit
Okay.
and talk about something that can be a bit confusing:
Well,
choosing the right accounts for your investments.
right.
The author devotes a whole chapter
A whole chapter.
to 401k,
Right.
IRAs, Roth IRAs,
Yeah.
and other tax-advantaged accounts.
Gotta love those tax advantages.
It's a crucial aspect of financial planning,
Yeah.
as these accounts offer significant tax benefits
Yeah.
that can help you build wealth faster.
More money faster.
Exactly.
Right.
Now, he seems particularly enthusiastic about Roth IRAs.
Roth IRAs.
He calls them the holy grail of retirement accounts.
The holy grail.
I've heard that term before,
Yeah.
but I'm not entirely sure why they're considered so beneficial.
So with a Roth IRA, Your contributions are made with after-tax dollars,
Okay.
meaning you've already paid taxes on that money.
Right.
But the beauty of it is that when you withdraw the money in retirement,
Yeah.
both your contributions and your earnings are completely tax-free.
So you're not paying taxes twice?
Exactly. It's like a double win.
That's awesome.
Yeah. And unlike traditional IRAs,
Okay.
there are no required minimum distributions with a Roth IRA.
So you can just let it grow.
That means you can let your money grow tax-free for as long as you like.
That's amazing.
Yeah, pretty sweet.
I'm definitely going to have to look into that further.
Yeah, you should.
He also discusses health savings accounts, or HSAs,
HSS.
as a potential investment vehicle.
Interesting.
You can use them to pay for medical expenses.
Right.
But he suggests considering them a super IRA
A super IRA.
because of their triple tax advantage.
Triple tax advantage.
What do you mean by that?
Well, first, your contributions are tax deductible,
Okay.
meaning you reduce your taxable income in the present.
Right.
Second, the money grows tax-free inside the account.
Okay.
And third, if you use the money for qualified medical expenses,
Yeah.
your withdrawals are tax-free as well.
Wow. So you're saving taxes on 3 different levels.
Exactly. It's like a trifecta of tax benefits.
I never thought of HSAs as an investment tool,
Yeah, they can be pretty powerful.
but that makes a lot of sense.
Yeah, you got to be strategic.
He seems to really emphasize maximizing every opportunity to reduce your tax burden
Absolutely pay less taxes.
and keep more of your hard-earned money.
It's your money. You earned it.
Now, before we move on to part 3,
Okay.
where we explore what life looks like after you achieve financial independence,
Right. Do good stuff.
I want to touch on one more topic that sparked my interest:
What's that?
the author's perspective on financial advisor.
Oh, yeah, this should be good.
He doesn't hold back.
I bet.
He seems to be quite skeptical of the financial industry as a whole,
Yeah, I've heard that before.
arguing that it's rife with conflicts of interest.
Interesting.
He even suggests that choosing a good financial advisor might be harder than picking winning stocks.
Wow, that's saying something.
Well, he's not entirely wrong.
Okay.
There are a lot of advisors out there who prioritize their own profits over their clients' best interests.
Yeah, some bad apples.
They might recommend products that generate high fees for them,
Right.
even if those products aren't the best fit for their clients.
It's all about the commissions.
It's like going to a car salesman
Oh, yeah.
who's trying to sell you the most expensive car on the lot,
Even if it's a lemon.
even if it's not the right car for your needs.
Right.
And he argues that many advisors rely on actively managed funds,
Actively managed funds.
which, as we've discussed, tend to underperform index funds over the long term.
Yeah, those high fees eat into your returns.
So his advice is to become knowledgeable about investing principles.
Okay.
So you can make informed decisions about your own money,
Be your own advisor.
rather than blindly following someone who might not have your best interests at heart.
Do your research.
He believes that with a little effort,
Yep.
anyone can learn enough to manage their own investments
to control.
and avoid those high fees and potential conflicts of interest that come with relying on advisors.
I like that message.
And while he acknowledges that seeking professional advice might be warranted in certain situations, like complex estate planning,
Right.
he encourages readers to do their due diligence,
Yeah.
interview multiple advisors,
Different perspectives.
and fully understand their fee structures and investment philosophies
Don't be afraid to ask questions.
before entrusting them with their hard-earned money.
Absolutely.
It's all about being an informed and empowered investor.
Take charge of your finances.
And that brings us to the end of part 2.
Part 2.
We've explored some of the key elements of the Simple Path investment strategy.
Right.
Index funds,
Yep.
bonds, asset allocation,
Right.
tax-advantaged accounts,
Tax advantages.
and the potential pitfalls of relying on financial advisors.
Got to watch out for those fees.
In part 3,
Cool.
we'll delve into the author's perspective on what happens after you achieve financial independence.
The fun part.
What does life look like when work becomes optional?
Oh, yeah. Early retirement.
How do you manage your wealth to ensure it lasts?
Make it last.
And most importantly, how do you create a life of meaning and purpose
The big question.
when you're no longer driven by the need to earn a paycheck?
I can't wait.
All right, welcome back to the deep dive. We've spent the last 2 parts really getting into the nitty-gritty of this simple path to wealth.
Right. All that investing stuff.
Exactly, like how to build a solid financial foundation, how to make smart investment decisions.
The building blocks.
Now let's shift gears a little bit and
Right.
talk about the ultimate goal.
The dream.
What life actually looks like
Right.
once you achieve financial independence.
The fun part.
This is where I think the book gets really inspiring.
Oh, I saw.
It's not just about accumulating wealth.
Right.
It's about what you do with that freedom once you have it.
Freedom.
The author encourages readers to really define their why.
Their why.
What truly motivates them, brings them joy, gives their life purpose.
So it's about more than just money.
It's not just about retiring early and sitting on a beach somewhere.
Right, you got to have a purpose.
It's about using that newfound freedom to pursue your passions and make a meaningful impact on the world.
I like that.
Now, I know one of the first questions that pops into people's minds when they think about financial independence.
What's that?
Is how much can I spend each year without running out of money?
The $1,000,000 question.
So I'm guessing the author has some thoughts on that.
He revisits the 4% rule.
The 4% rule.
Which suggests that you can safely withdraw 4% of your portfolio each year in retirement.
Okay.
Without depleting your savings.
That sounds pretty good.
Yeah, it's a good starting point.
Yeah.
But he stresses that it's not a magic formula.
Right.
Flexibility is key.
Okay.
You need to be prepared to adjust your spending based on market conditions,
Okay.
unexpected expenses, and your individual needs.
It's not just set it and forget it.
No, you got to be adaptable.
So, for example, let's say the market takes a significant diff.
Oh, yeah.
Would you recommend reducing your withdrawals?
I would admit you to allow your portfolio time to recover.
Okay.
It's all about being adaptable and making adjustments as needed.
Makes sense.
He also points out that the 4% rule assumes a 30-year retirement horizon.
Okay.
So if you plan to live longer,
Right.
you might want to consider a lower withdrawal rate.
Just to be safe.
Just to be on the safe side.
Sounds like it's a constant balancing act.
It is.
Enjoying your newfound freedom while also being mindful of the need to make your money last.
You got it.
He also discusses the role of Social Security.
Oh, yeah, Social Security.
In retirement planning.
Okay.
He views it as a valuable safety net.
Right.
Especially given its inflation-adjusted benefits.
Yeah, that's a big plus.
Now, I was particularly intrigued by his approach to withdrawing money from his portfolio.
Oh, yeah, this is interesting.
It sounds like he takes a very active approach.
He does.
Rather than just setting up automatic withdrawals and forgetting about it.
Not passive.
So he describes a strategy where he primarily uses dividends and interest payments.
Dividends and interest?
From his investments to cover his living expenses.
So he's living off the income.
He only taps into his principal when it's necessary.
Okay.
And he prioritizes withdrawing from his taxable accounts first.
Ooh, to minimize taxes.
To minimize his tax burden.
Smart.
So he's not just passively letting his money sit there.
No, he's working it.
He's actively managing it to make sure it continues to grow and support his lifestyle.
Being proactive.
Now, one of the most compelling parts of the book, in my opinion, is when he shares stories of people who have used their financial freedom to create truly meaningful lives.
The inspiring story.
It's inspiring to see how they're using their time and resources to pursue their passions and make a difference in the world.
Yeah, like what kind of stories?
Like that story about Muck, who went from owning a failing pineapple plantation to building a successful hotel in Tahiti.
Quite a turnaround.
Talk about resilience and a willingness to adapt.
You didn't give up.
It shows that even when faced with setbacks, financial independence can give you the flexibility to pivot and create a new path for yourself.
You're not tied down.
And then there's the couple who used their financial independence to sail the South Pacific.
Oh, wow. Living the dream.
They created a unique business partnership that allowed them to work remotely. And enjoy a life filled with adventure and exploration.
That's awesome.
These stories really highlight the transformative potential of financial freedom.
It's life-changing.
It's not just about having money.
Right.
It's about having the time and resources to pursue your dreams and live a life that's aligned with your values.
Living authentically.
And speaking of values, the author emphasizes the importance of giving back.
Giving back.
Once you've achieved a certain level of financial security, he talks about the concept of giving like a billionaire.
Giving like a billionaire.
Which essentially means using your wealth to make a positive impact on the world.
I like that.
It's a powerful reminder that financial success isn't just about personal gain.
Right.
It's also about using your resources to help others and make the world a better place.
Paying it forward.
He encourages readers to think about the causes that they care about most deeply.
Yeah, find your passion.
And find ways to contribute their talents or their financial resources to those causes.
Making a difference.
Now, he also offers some practical advice
Okay.
on navigating that transition from a life of work to a life of financial independence.
Yeah, that could be tough.
It sounds like it can be a tricky adjustment for some people.
It is. It is.
He talks about the importance of creating structure,
Sure.
setting goals,
Goals.
staying connected with your community, and finding ways to stay engaged and mentally stimulated.
Staying active.
He suggests that work, even if it's not driven by financial necessity,
Okay.
can still provide a sense of purpose and fulfillment.
Yeah, you're not just sitting around.
It's like he's saying, don't just retire from something, retire to something.
I like that.
Find something that gives you a sense of purpose
Right.
and keeps you engaged with the world.
Makes sense.
And in his closing thoughts, he reminds readers that there's no such thing as a risk-free life.
That's true.
Investing inherently involves taking on some level of risk.
There's always risk.
But he encourages readers to view risk as something to be managed, not feared.
Manage the risk.
By following the simple path principles.
The principles.
Simplifying your life, investing wisely, and avoiding debt.
Right.
You can minimize your financial risk and create a solid foundation for long-term wealth.
Building that foundation.
And perhaps the greatest risk of all is not taking any risk at all. By playing it too safe, we might miss out on opportunities for growth, adventure, and ultimately a more fulfilling life.
Gotta take some chances.
Well, that brings us to the end of our deep dive into the simple path to wealth.
It's been a great journey.
We've covered a lot of ground, from the fundamentals of investing to the transformative power of financial freedom.
It's been inspiring.
It's been an inspiring and thought-provoking journey, and I hope you've gained some valuable insights along the way.
I know I have.
Remember, the journey to financial independence starts with a single step.
One step at a time.
So what will your first step be? Until next time, keep diving deep.